Hello everyone, welcome to the Hidden Game. In this video, let's talk about the hidden debt that lies at the heart of the artificial intelligence boom. Let's look at some of the biggest names behind the artificial intelligence booms. The companies like Alphabet, Meta, Microsoft, Amazon, and Oracle, these companies are sitting on a really strong balance sheet. The balance sheet shows that these companies are generating a lot of profit, sitting on a large cash reserve, and when they have to foot the bill for artificial intelligence build out, for data centers, for infrastructure, it appears that these companies are able to do so comfortably. But what if I were to tell you that these companies are also sitting on a lot of financial obligations and debt outside their balance sheet, outside from what shows up on their balance sheet? Because once we account for this information, this whole notion of profitable companies uh, slightly changes. Let's get to the heart of this video right away. A recent Nikkei study published on the Next Web reports that the five major technology companies behind the artificial intelligence boom, we are talking about Amazon, Microsoft, Oracle, Meta, and Alphabet. These companies have amassed close to $1.65 trillion worth of financial obligation and debt outside their balance sheet. We are talking about a sum which is more than the conventional debt these companies report on their balance sheet, which is close to $1.35 trillion. These off balance financial obligations not reported in their balance sheet have increased close to eightfold in last 4 years. Is this something worrying? Should the investors be worried about this number and these obligations? Let's break it down in this video. Look, artificial intelligence is an extremely expensive enterprise. We are not just talking about the software anymore. Whenever you use an artificial intelligence chatbot or the LLMs, a really expensive infrastructure sits right behind it. We are talking about expensive real estate, expensive GPUs and chipsets, cooling systems, expensive data centers. There's a whole gamut of industry that is sitting right behind it, and it is not coming in cheap. Some estimates suggest that this artificial intelligence industry could burn close to 3 trillion US dollars by the year 2028. I'm recording this video on July 29, 2026. We are talking about next 2 years where this massive amount of money will be consumed in building the data centers and the infrastructure supporting the artificial intelligence industry. Now, companies have primarily two ways to finance this endeavor, the artificial intelligence endeavor. The first way is to issue bonds out in the market, raise capital from there, show that as a debt on their balance sheet, and pay for this expensive, infrastructure. The second approach is for companies is to structure this expense in, long-term leases, SPVs, VIEs, some financial instruments, long-term purchase commitments. Do all this to distribute the financial and legal risk across multiple entities, and do not show the debt obligations on their own balance sheet. So, and this is where we get into legal or ethical gray area, because now we know that the particular company is connected financially with the infrastructure, but the obligations do not show up on their balance sheet anymore. So let's understand this using a simple example. Let's say for some arbitrary reason you have a need to build a $10 billion data center. What would be the next logical step for you to do? You would go to a bank, request for a $10 billion loan, and assume that that loan gets approved for you because of your high credit worthiness. You would own that as a debt for yourself. You will go ahead and build that data center. You own that data center fair and square, and generate revenue from it for some valid or legal enterprise. But that debt will show up on your financial statement as long as that debt is not paid off. And any credit worthiness check for you as your enterprise or for you yourself will be accounting this debt on your balance sheet. This is how any typical loan would work for you. But what if you can create a new company, let's say company B, that can go ahead to the bank and raise that particular amount of capital required to build the data center and actually build that? And let's say your company, company A, signs a long term lease with company B, right? And they are able to help you with certain decisions in building the infrastructure, and they are able to help with managing the facility. Now, company A, that is your company, doesn't need to show this particular long term lease or the cost to build the company, they build the data center on their balance sheet, because that risk is now held by the company B, which actually took out the loan and is owning the data center. So, the question at the heart of this transaction, this contract, is who owns the debt obligation for building out the data centers? Is it the company A, which is which has promised to manage the data center, or is providing certain directions on how the data center should be built because they are the sole tenant? Or is it the company B which requested the loan, got it approved, and is eventually going to be building out the data center? The accounting rule suggests that a lot of times the debt obligation determination lies with the company which owns the economic exposure and has the decision making ability for the particular data center. But as you can see, like, this determination becomes really tricky to prove or disprove, and a lot of times the final decision is dependent upon what were the terms in the contract signed between entity A and entity B. One of the most interesting case study around this involves the company Meta. Meta partnered with Blue Owl Capital, a private equity firm, to build a massive data center project in the state of Louisiana, and they named the project Hyperion. Now, this project, uh, the joint venture around it, they raised a debt of $27 billion to build out the data center. And the way this deal was structured was there was another entity that will act as the landlord for this facility, and Meta was going to be the sole tenant for this data center. So according to the Bloomberg law that reported that Meta's maximum exposure from this project was close to $46 billion, and once fully built out, this project expected to spend close to $250 billion. So Meta's position on this debt, this massive amount of debt required to build the data center, was that it doesn't belong on their balance sheet, and the rationale provided was based on the control and economic exposure. From Meta's perspective, they didn't control this data center facility, and that's why it didn't belong on their balance sheet. However, some analysts disagree with this position, and the rationale for this disagreement is fairly straightforward. You see, Meta is the sole tenant of this particular data center, is going to be the sole tenant for this data center. They also have enough say to decide how this facility gets built and how this facility gets managed thereafter. So even though the debt doesn't sit on Meta's balance sheet, they definitely have certain responsibility towards servicing the debt arising from this data center. So this is the heart of the debate. The question is not that Meta is doing something illegal, because what they're doing is perfectly legal. The question is, does the balance sheet show the actual amount of obligation that a company like Meta is owning, and what do investors need to look at beyond the balance sheet to understand what are the total financial obligations for this company. Alphabet have used these financial structures to raise debt for data centers and power infrastructures, and they have not consolidated it with the conventional debt. Microsoft, similarly, they have disclosed using the VIEs or virtual interest entities to raise debt, and again they do not consolidate these debt with their conventional debt on their balance sheet. Oracle, on other hand, they have signed up for massive future lease commitments, and for the data centers and kind of other financial obligations. Similarly, Nvidia as a company, they have signed up or have made the purchase commitments for chipsets and chipset related products for AI supply chain. Now, all these future commitments for purchase and for future leases, they do not become the financial obligations as of today, right? But even then, like, these are financial obligations, and the bill will be due sometime in future. If you were running your personal finances like this would have been like a massive red flag for any company or any bank thinking about issuing you a loan for home or for car. Let's imagine, like, as an individual, say that you have $1,000 debt, but you do not disclose that you have, for example, $10,000 obligation towards some entity or some individual out in future. And just having this information to a creditor, with a creditor, would change the perception about you and your credit worthiness immediately. Whenever people hear about off the book or off the balance sheet financial obligations, the conversation about Enron inevitably enters the room, right? Close to 25 years ago, there was a company named Enron. I think a lot of people from a certain generation and older, they would know about this company. This company, uh, you know, it was a huge scandal back in that day, where this company used a lot of financial instruments to keep the debt off its balance sheet. That way it showed the company to be in a really great financial health, when the truth was completely opposite. Now, the problem was not exactly using these financial instruments, the problem was actually hiding it. So the company was hiding the true financial obligations from the investors and not even reporting it. So today's situation is not exactly like the Enron situation 25 years ago. Today, the accounting rules are way more stricter than what they used to be in terms of financial disclosures. The expectation for financial disclosures are higher as well. There is more documentation required to put a full picture of the financial obligations that a company is encountering, and the joint ventures and lease agreements that the company is signing up for. So today's world is not exactly like back the Enron world back 25 years ago. So with so much of stringent requirements around disclosures and following the accounting rules, what is the problem? So the problem is complexity. Now, for a particular company to be evaluated, all of their financial obligations do not show up in a nice balance sheet, right? Now, the financial obligations come up in various forms, and all of them are disclosed in the fine prints of the financial disclosures for these companies. We are talking about joint ventures that the company is getting into, the long-term lease commitments that the company is getting into, the special purpose entities that the company is creating to own part of the financial risk or the legal risk involved in a certain project. So all this complexity of identifying the true financial obligation for a particular company now sits with the investor. Now, this investor may be investing their own money or working through or for a financial organization managing endowment funds or 401ks or pension plans. And the onus for diagnosing or figuring out this complexity solely sits with the investors themselves. Now, they are the ones who need to figure out what is, how this particular web of financial transactions uh, paint a accurate picture of the financial obligations for a particular company. The question about complexity leads to the second question or follow-up question, and that is, what if the investors are not able to generate the returns from the artificial intelligence investment? To understand this question better, let's try to understand what these companies are actually building. Now, these companies are building, billions of dollars of data center that require massive amount of real estate, massive amount of power consumption, and they are going to be buying really expensive chipsets and GPUs and technology infrastructure required to run a really large data center. These companies will be using really expensive, sophisticated cooling systems, and these companies are going to be signing for really long-term leases to keep the operation running year after year. So all those things are being committed today, but let's see what may happen in future. In future, these chipset technologies may get outdated faster than what the companies are expecting right now. There could be new models or new ways of running artificial intelligence software that is more efficient. Let's say a new model comes from China, an open source model that reduces the need for compute power drastically, and all that compute power that is being built in these data centers do not have as much use anymore. Let's say hypothetically that the demand that is being expected from the market for artificial intelligence technology doesn't increase the way these companies are currently expecting. Let's say the demand grows at a much slower pace than what is currently anticipated. All this situation, a lot of things can go bad because we are talking about a lot of things happening and a lot of investments returning return at a certain rate, and if any one of them doesn't really work out the way we are originally planning, uh, things may go south. So the companies may be logged in with this expensive infrastructure, expensive hardware, and expensive lease terms for really long time. And what if the return doesn't actually come for these expensive infrastructure? Then the companies will still have to service these debts, these financial obligations, but there will not be a return coming up from these investments to justify those debt obligations. Artificial intelligence could be the most transformative piece of technology that the human species have ever developed or encountered in their entire lifetime on planet Earth. But it does not mean that this technology will come in cheap. This is perhaps the most expensive technology that humankind have built. And for a lot of these companies, even though their off-the-book debt obligations now surpasses their conventional debt on their balance sheet, it doesn't mean that we are into an artificial intelligence bubble or if it is going to pop right away. The companies and their net worth and their obligations and their performance may wax and wane with time, but as an industry, as a sector, we may continue to see development and improvement for a really long period of time. And very importantly, companies owning off the book or off the balance sheet debt obligations is not necessarily a fraudulent activity in itself, right? Companies have legitimate reasons to use these financial instruments to distribute the legal or financial risk involved in any technological project, right, going forward. So what it means is that investors will have to look closely at the financial obligations for a particular company and not just focus on the headline numbers on their balance sheet. If everything works well for the artificial intelligence demand, and the companies involved in the industry, they are able to monetize their investment, the investor is able to get the returns, everything is fine. However, in a case where the demand doesn't meet the expectation, the monetization, artificial intelligence monetization expectations are not met, a lot of these financial instruments will start to buckle on that particular pressure. And at the end, who gets left with the bag? It is the investor. And it is going to be those financial institutions who are managing the endowment funds, the 401ks, the pension funds, who are going to be the real sufferers. With that said, I will end the video here. If you like what we talked about in this video and in this channel, please like and subscribe. And thank you for watching. I'll see you in the next one.